So hi guys, my name is Nicolette Mashile. I'm also known as the Financial Bunny. Welcome to the Financial Bunny TV. Today we're talking all things, or rather we're asking this question: should I be paying off my debt first or should I be investing? Now remember that none of my videos constitute as financial advice. If you are looking for financial advice, please speak to somebody that is certified and registered with the FSCA. So let's talk a little bit about a typical budget. On a typical budget, what you would have there is your living expenses, you would have your savings technically. You also would have what is called your contractual debt. Your contractual debt would be debt where you have a credit agreement in place. So you actually have an obligation to make those payments every single month. This may include a bond, this may include a car, this may include a credit card, and all sorts of other things, right? Those are what we call contractual debt. On many people's budget, those things already exist. What might be missing is one investment portfolio or investment funds or investment accounts. But however, some people may have things like a life insurance, they may have things like a funeral cover. While those things fall under insurances, they can double up also as savings accounts. The other things that people may also have is that they may be paying, for instance, 300 Rand towards a company like Old Mutual or 300 Rand to Sanlam, and they may call it an investment. It's important to understand that wherever you're putting money away for growth, it is indeed an investment. So already you might find that this answer is already, or this question rather, is already answered. You already are doing both of those things. What you do need is to have a little bit more of a tighter strategy in terms of, are you aggressively going to be paying off debt so that you can free up some money to invest, or are you going to be doing these two things interchangeably at the same time? Well, in my opinion, there are two ways in which you can look at it. You can either, one, do both at the same time, depending on the types of debt that you actually have. Secondly, you could choose to pay off the high interest rate debt, the most expensive debt that is taking away a big chunk of your cash flow. What do I mean when I say that? Well, essentially what I mean is you may find that you've got what is called unsecured lending or unsecured debt. This is debt that you borrowed against no asset. So there was no actual asset that you borrowed this type of money against, or you used a credit facility that did not require you to put down an asset as a collateral or something that backs up that type of credit. These credits are credits that are called credit lines, such as your overdraft, your credit card, your personal loans, I would say a store card, because a store card also really doesn't prescribe an asset for you to be able to gain access to that credit line facility, even though you are using it to buy specific things from a specific shop or network of shops. So that is what is called unsecured lending. If you were to look at the direct opposite of what unsecured lending is, you are now looking at credit facilities such as your vehicle asset finance, which is a car loan, your home loan. Why we call these secured lending, even inclusive of your student loan and business loan. The reason why we call these secured loans is because, first and foremost, they prescribe the type of asset that this specific line or money can be used for. You cannot take a home loan and then want to use that money to buy a car, because the bank prescribes the type of asset that specific credit line must be used for. The reason for this is that if you do default on your repayment on that specific credit line, there is an asset that can be repossessed, sold, so that the bank can recover its monies. Now, generally what happens with these two types of asset line or credit lines is that your secured credit generally attracts very low interest rates. When you do the calculations, because of a lower interest rate, it means that generally you're going to pay a lower installment amount, right? Now, that is very important, because a lower installment amount means that it also takes up a lower portion of your cash flow. What is your cash flow? It is your money that you get as an income that is in cash base. So you want to make sure that you have a higher cash flow even after you have paid all of your liabilities, and that is called disposable income, so that you can use that money to be able to save and invest. So ultimately, we need to get you to a point where your cash flow is quite high. And the only way you can do that if you do have debt is by ensuring that the installment that you pay, the monthly repayment that you pay back to the bank, is quite low. Which is why we always encourage that if you are going to be taking up any sort of credit line, using that credit line to be able to increase your net worth or buying assets that are going to make you money, you need to make sure that you are negotiating well so that that interest rate that they're charging you does not result in a high installment amount. The only way to do that is to bring down that interest rate. The only way you can bring down the interest rate is by making sure that, one, you are buying assets when you are borrowing money, but two, also you've got a good credit record to be able to do that. So put that on the other side. Let's come back to the question of the actual video. Do you pay off your debt first, or do you actually invest? Remember, I've given you two propositions. I said, one, you either do both of them at the same time, which is what a lot of people kind of get into a space of, but they don't realize they are doing so because many of us don't consider putting money away, for instance, in a unit trust with an old mutual or with a Sanlam as investing. Most of us think that investing is when you are going on easy equities and you're buying shares or you've bought a property. That is not necessarily always investing. And remember also, over and above that, when you have taken up a loan, for instance, for an investment property, that in itself is also investing. So don't look at a linear way of looking at investing and jumping on the investment options that many people have popularized and think that if you're not part of those things, you are not actually investing. You are actively also part of investing. Of course, the assets that you're investing in may look differently. The strategy in which you are investing may look differently, but also the financing of buying those assets that you're investing in may look different from somebody else that may be financing their investment from their disposable income. So that's the one way of looking at it. The other way, which is what I was getting to when I was speaking about secured and unsecured lending, making sure that if you have debt that is coming from an unsecured lending facility, then you need to pay off that debt, because we know that unsecured lending attracts higher interest rate. When we're talking about a credit card, we know that it is in the regions of 15% and higher. When we're talking about a personal loan, we know that it is within the regions of 17% and higher, or 15% if you've got a good credit score. So because we know that unsecured lending generally attracts higher interest rates and shorter periods of repayment, it means that the installment you're going to be paying is generally higher. And a generally higher installment takes a bigger chunk of your cash flow, and that means that you do not have the disposable income to be even more flexible in terms of the investments that you actually can finance. Now, one of the chapters in my book, which is called What's Your Move, is called Paying Off Debt is the Best Investment. And this is where I actually put this proposition to say, think about it this way. Any type of lending is going to end up being an investment for the credit provider. Why do I say this? Whether you are borrowing money or you are investing, somebody is going to get a rate of return or an interest return back. It's either you or it's either the credit provider. When you are investing, you get back the interest rate. Generally, if we're being fair, most of the investment options that are available to a lot of us generally don't give us a very good rate, right? You are lucky in South Africa if you can get an investment fund, investment asset that can give you back 10%. And now we're talking a little bit about more of paper assets. We're talking about real estate, right? Business, it's something different. A business can give you even 50% rate of return back if you go into a business where the market and the demand is quite high. But when we're talking a little bit about things like your bonds, when we're talking a little bit about things like the stock market, when we're talking a little bit about things like your real estate, we know Unless, of course, if you're talking about real estate and you're talking about flipping houses, again, those types of things where you add an element of trading, we know that the rate of return kind of goes a little bit up. But when talking investing in real estate, investing in rental property, for instance, investing in REITs, for instance, investing in listed property, for instance, we know that the rate of return kind of comes a bit low. But think about it the other way, when the credit provider is the one that is getting the interest back. When they borrow you money under unsecured lending, overdraft, credit card, personal loan, how much is the interest rate that they're charging you? As I said earlier on, it's between the regions of starting even from 15% up. They are receiving 15% plus account management fees from you every single month. So there's definitely somebody who's sitting there and saying, yo, Utabo is a good investment for us. Mapula is a good investment for us. Nicolette is a good investment for us. Simply because they know that when it comes to unsecured lending, they are actually getting a higher rate of return based on the interest rate that they are charging you. And the reason why they also have to do this is because they have to cushion themselves from the risk that is attached to unsecured lending. Because many people, let's be fair, in South Africa, do default from paying off their credit cards. They default from paying off their personal loans. That is why you will hear cases of people, for instance, that lady who went into Capitec naked and she threw a tantrum. And let's be fair, reasonably so, because when you don't understand the interest rate and what it actually means, you can get yourself into a frenzy if you are paying every single month, but that principal amount that you owe is just not going down, simply because the first couple of months or years of you paying off a personal loan on any type of unsecured lending, we know for a fact that you are paying the interest portion first. So it's important to never ever forget that when you are borrowing money from someone else, you become their investment. The interest rate that they're charging you is their interest rate that they are getting back, the rate of return that they're getting back from you being the actual investment. So your income, your salary, however you make money, that becomes their income, essentially. So it is important that you pay off that expensive debt first before you even start thinking about putting that money away into investing, because actually paying off expensive debt is the real investment. You can get that money back. You can free that money back so that you can channel that money into your own investments.